Hey there, my fellow subscribers. Today we are going to talk about one of the most significant economic events of recent history, the 2008 recession. This was a time of great financial upheaval and crisis, affecting millions of people around the world. So, let's dive in and explore what happened during this challenging time. First of all, let's get some background information on what led up to the recession. It all began in the early 2000s when there was a boom in the housing market. People were buying houses left and right, and prices were soaring. The banks were getting in on the action too, offering mortgages to people who couldn't afford them. This led to the creation of subprime mortgages, which were given to people with poor credit scores. These mortgages had a high risk of default, but banks were happy to lend money to anyone because they could sell the mortgages to other investors. This created a bubble in the housing market, and everyone was making money. However, things started to go downhill in 2007 when the number of mortgage defaults began to rise. This was because people who couldn't afford their mortgages were defaulting on their loans. The banks were left with these bad loans, and they were unable to sell them to investors. This created a chain reaction, and the banks began to suffer huge losses. This, in turn, led to a decline in the value of their assets, such as stocks and bonds. With banks struggling, the entire financial system was at risk. Banks started hoarding cash and were reluctant to lend to one another, which caused a credit crunch. The credit crunch led to a decline in consumer and business spending, which further worsened the economic situation. As people and businesses struggled to get access to credit, they started cutting back on their spending, which led to a decrease in demand for goods and services. The decline in demand led to layoffs and unemployment, which in turn led to a further decrease in demand. This created a vicious cycle that continued to worsen the recession. To try and prevent a total economic collapse, governments and central banks stepped in. They implemented various policies to try and stimulate the economy, such as lowering interest rates and providing financial aid to struggling businesses. However, the recession still lasted for several years, and it took a long time for the economy to recover. In the United States, for example, the recession officially ended in 2009, but it took until 2015 for the country's unemployment rate to return to pre-recession levels. The impact of the recession was felt around the world, and many countries were hit hard. Some countries, such as Greece, suffered particularly severe economic crises, which they are still recovering from today. The recession also had a significant impact on the stock market, with many investors losing large amounts of money. The Dow Jones Industrial Average, for example, fell by over 50% during the recession. Many people lost their homes during the recession, as they were unable to keep up with their mortgage payments. This led to a significant increase in homelessness, particularly in the United States. The recession also had a significant impact on small businesses, many of which were forced to close their doors. This led to a loss of jobs and had a negative impact on local communities. Despite the negative impacts of the recession, there were also some positive outcomes. For example, the recession led to an increased focus on financial regulation, which has helped to prevent similar crises from occurring in the future. The 2008 recession also highlighted the need for increased transparency in the financial sector. Many people were shocked to learn about the complex financial instruments that banks were using, and the lack of oversight that existed. The recession also had a significant impact on the real estate market, which has been slow to recover in many areas. In some parts of the United States, for example, housing prices are still below pre-recession levels. One of the most significant consequences of the recession was the impact it had on the job market. Many people lost their jobs during the recession and were unable to find new employment. This led to a significant increase in long-term unemployment. The recession also had a significant impact on the mental health of many individuals. The stress of losing a job or being unable to pay bills can take a significant toll on a person's mental well-being. In addition to the financial impact of the recession, it also had a significant impact on the political landscape. Many people became disillusioned with politicians and the government, which led to a rise in populism and anti-establishment sentiment. The recession also had a significant impact on global trade, with many countries turning inward and implementing protectionist policies. This had a negative impact on many industries, particularly those that relied on international trade. The recession also highlighted the need for increased financial literacy. Many people were caught off guard by the complexity of the financial instruments that banks were using, and were unable to make informed decisions about their finances. The recession also had a significant impact on the retirement savings of many individuals. With the stock market taking a significant hit, many people saw their retirement savings decline significantly. The 2008 recession was a wake-up call for many individuals and businesses. It highlighted the need for increased financial stability and the importance of planning for the future. In conclusion, the 2008 recession was a challenging time for many people around the world. It had a significant impact on the global economy and the lives of individuals and families. However, it also led to increased awareness of financial stability and the need for increased transparency in the financial sector. We can only hope that we have learned from the mistakes of the past and can prevent similar crises from occurring in the future. Thanks for watching.